You are watching Morning Markets on BNN Bloomberg. Thanks so much for joining us. We are starting this Monday with anticipation. There's not a lot to chew on today, but we are leading up to a lot of things to chew on during the week. We're going to have a big read on the tech sector, starting with Microsoft after the bell tomorrow. We're also going to get Tesla earnings. We're going to get a read of the U.S. economy, first reading of Q4 GDP later on in the week. And while that is backward looking, there's one index that just broke at around 10 a.m. Eastern time, so 5 minutes ago, the leading indicators index. So that tells us where we're going. And yet another indicator that is starting to show weakness under the surface. The leading indicator index declining more than expected, deteriorating by 1%. We were looking for some deterioration of 0.7%, but throw this into the pile of weaker U.S. retail sales, throw it into the pile of weaker services sector reading where we saw unexpected contraction for the month of December, and contrast that with what we're seeing in the markets, a little bit of a rally here. Now, despite the fact that we are seeing a rally, there has been a certain stubbornness to the S&P 500. Take a look at the S&P against its 200-day moving average. That has proved over the past year to be a stubborn lid of performance for the S&P 500. Just can't get meaningfully above that level. We'll see if today marks a sustainable breakout for the S&P 500, but this is coming at a time where global markets have been able to break above the 200-day moving average. Let's take our own TSX, for example. Not only has it sustainably broken above its 200-day moving average, but it has also experienced a golden cross. It's a technical indicator when your short-term average, the 50-day moving average, moves above the long-term average, the 200-day moving average. In technical terms, that's seen as bullish. And you can see that when that golden cross happened, we did see the TSX rally. And while the TSX has recently broken above its 200-day moving average, take a look at the European market. Just measured by the Euro Stoxx 50, it's looking at the 200-day moving average in the rearview mirror. It crossed above that back in the fall of last year. It has moved sustainably above it and held above it since then. And even the 200-day moving average, which was downward sloping, is now upward sloping. Maybe, like all things fashionable, starts in Europe. Will it come to North America? Our next guest is not so sure. In fact, seeing another 20% drop, perhaps, for the S&P 500 from here. We've got Phillip Toews. He's the CEO and portfolio manager at Toews Asset Management. Thanks so much for joining us, Phillip. So I was just talking, in technical terms, very stubborn. The S&P 500 has not been able to meaningfully break out. And there's a lot of fundamental reasons for that are perhaps keeping us on the sidelines. And that seems to be your focus right now.
Right. So we're looking at some leading indicators. For example, consumer sentiment hasn't been awesome over the last month or so. Also, the PMI index, durable goods orders have remained pretty impressive. But if you look at the PMI index, which is what purchasing managers are doing, it's more leading, that's already turned lower. So I think that potentially here we'll grind down. But again, when I've been on the past on your show, I've talked about the fact that the short-term markets can be inexplicable. If we can pay, infinity times zero earnings for crypto, for Bitcoin, why can't we pay 25 or 30 times earnings? So within this larger perspective of, I think, caution, which investors should definitely be thinking about right now, there's still the possibility that we could move higher. And, we have rallied higher this year. And it's also important, as you were mentioning, to look globally. Developed international and emerging markets have rallied very nicely. And boy, it's been so long since we've seen that. So one has to be open-minded, think about opportunities, and be agile for both the potential for a rising market, but also for something moving down.
One of the things I like to use to gauge investor sentiment, to contrast your views on consumer sentiment, is that CNN Fear Greed Index. It's in greed territory. It has been since last week, I think. We're not quite in extreme territories, but, we're getting these mixed signals. While the economic data, to your point, is deteriorating, copper's rallying, oil's rallying. These are all economic touch points. And so I'm having trouble kind of making sense of the market signal versus the fundamental signal.
Well, join the world, because no one really knows which direction we're going. What's interesting is here's a different way to frame it, right? Because everyone's trying to decide, are we going higher, are we going lower, and then positioning themselves. And what I've said before when we've talked is I've said what it pays to do is position yourself so that you're there, so that you're broadly invested in the markets if they move higher, but address contingencies. And that's the missing component. That's the missing component that people aren't doing, in our opinion, because they're just looking at the way that over the long-term markets go higher. And here's the risk. Here's the risk going forward. We already saw the S&P finish down about 20% last year. Bonds were down more than 10% last year. So the real risk for the investor out there is that we do punch lower below, this bull market that's lasted for a couple of weeks ends. We punch below the lows of the year and we move down further. And that's when it really gets painful. It takes both a large percent decline and a large duration decline before most people are really negatively affected.
Okay, so people will say we already experienced the negativity because we had this washout year where prices move below, and the markets are forward looking, and so they've already priced in all this economic weakness. This is kind of confirming that. And if you look historically, and I'm going to show this later on in the show, but I'll give it away now, the market bottoms before earnings bottom. And so maybe that weakness in earnings is already priced in. We know that the forecasts are going to be weak, but the markets being forward-looking are looking to, all right, we're going to start to get some accommodation from central banks. And so now I can price off that.
It's totally possible, but it's I was on Bloomberg Radio on Friday and I was talking about, as I've talked on your show before, about our best imaginary friend, the Fed pivot. And if you look at what's happening right now, it's just another example of being in denial about the fact that probably the Fed will continue to raise rates, and maybe inflation will continue higher. The history of the United States of inflation is not great. If you look at the last 3 episodes over the last 100 years, when inflation turned high, it stayed high for between 4 and 9 years, not 12 months. For people that are negotiating their wages right now, they're looking at the fact that inflation was up 8% last year, and they're asking for another 8% this year. So when people talk about inflation being baked in, that's the kind of thing they're talking about. Inflation labor may be very stubborn to come back down. We all know equivalent rents for housing, which is 40% of the CPI, is going to be probably advancing through 2023. And energy may continue to advance, as you were pointing out earlier. So inflation may be stubborn. This Fed pivot that everyone's already expecting based on how they're pricing bonds may not be realized.
One thing you mentioned, and you talked about crypto, and I know you're not a fan, but I like to use it now as kind of an indicator of animal spirits. And, certainly that was true when we were in this, unabashed bull market before 2022 hit. And so, that now that crypto is kind of perking up, even as, terrible things have happened in the space, the FTX collapse, people thought, okay, so that's it, crypto is dead. But the worst kind of happened already. And now you're moving on, you're seeing people pile back in. And I think it is 4 times above its 50-day moving average, or 4 standard deviations above its 50-day moving average. Does that tell you anything about the animal spirits and to your point about the risk that, yeah, you could see a sharp move to the upside?
I completely agree that it's a great thing to look at to try to gauge what the animal spirits of the market are, because it's one of the most volatile. It tends to correlate highly with equities as we've seen before. I'm pretty amazed at the rally that we've seen. It's just, it just shows you, in our opinion, what it says is it shows you that it's not over, right? Because it's a nothing asset. There are no earnings. It's not really a currency. It's just a speculative tool. What it is the most popular. I know people get annoyed when you refer to cryptocurrencies as a Ponzi scheme, but it is, because the only gains are coming because you're expecting other people to come in and buy later.
I agree. I just want to, because I hear this a lot, and I'm certainly not a Bitcoin maxi, and your points are well taken. And I think to some extent it's a solution in search of a problem. But just as a finance person, don't you think there's something radical about being able to engage in a transaction in a trustless yet transparent way? And while we're still looking for ways to apply that, a lot of smart people are working on ways to apply that, not necessarily with Bitcoin, but all sorts of projects. For me, it still blows my mind that people dismiss it because it's something that's never really been able to be done before, that I can engage with you without any middleman, but that we can verify for a fact that that transaction happened.
So I completely agree. I think it's super important to separate blockchain and cryptocurrencies.
You
right?
can't,
so
though. People say that. I'm going to interrupt again. You can't because it is the currency that propagates the network. That's how you get the currency.
Of course, but blockchain can do a lot of things other than just support cryptocurrencies. And so here's the way we would say it. It's a Ponzi scheme supported by an awesome technology. Right? Because the only reason people are bidding up Bitcoin is because they think other people will as well, and they'll get appreciation. They're not investing in it because it's a reliable currency. If it was just a currency, if you invested in $1 in 1950, it's worth exactly $1 today, except that inflation has happened, so it's worth about 25 cents. That's what a currency is. What Bitcoin is a speculative furor around the fact that people think that Bitcoin is going to go higher and they're going to be able to get rich. Blockchain could be potentially awesome. And look, if you're talking about just a currency itself, let's say you just have a flat currency and you've got all this global debt and you want to try to get away or escape from that and you want to seek refuge in that, fine, I'll buy into that argument as a possible benefit of something like cryptocurrencies. But that would be a safe haven. That should not be a place where you're going in and making 3 million % as Bitcoin has increased, since it was launched. So, I mean, it's really just, if it's stable, if it's current, if it's not inflating as highly, and if people aren't buying into it to try to make a fortune, we would potentially buy in. But that's not how it's being used.